Hello and good morning. It's Jeffrey Cohen. How are you? President, founder of Chicago Quantum or U.S. Advanced Computing Infrastructures. We're a registered investment advisor in Illinois, right here in Highland Park, and we would love to have you watch our show and to understand what we're doing. So, about a couple days ago, I posted a tweet that said, "Hey, now we're speeding up our analysis. We run it each night, not always, but most of the time, and we're looking at like 1,650 stocks, and we're trying to find the best portfolio. And in order to run it faster, we figured let's run only higher market cap stocks. And so here's what happens: when you limit yourself to a risk-off portfolio in a risk-off market with large cap stocks, what happens is there's not much edge over just buying the S&P 500. Because the S&P 500 gives you a market capitalization weighted, historically very kind of risk attractive way to invest your money. It's not bad. S&P 500, right? That's SPY, and you can see it's up today. You've also got NASDAQ for those who like to take a little more risk. QQQ is the ETF. And you got the Russell 2000, which is small cap. Now, I'm not going to make very much money as an investment advisor if all I do is tell you to go buy passive indexes. But for probably 90% of the investment world out there, for retail investors, just take your money every month that you save from your paycheck and drop it in one of these indexes. And in fact, we use Vanguard. I've still got money in Vanguard passive S&P 500 indexes for 20 years. It's great, right? So here's what happened, though. We said, you know what? We sped it up. It was great. We got it down to like an hour and 11 minutes to run. But I was getting risk off, and that meant 40 stocks. How are we going to manage 40 stocks every day, equally weighted? We got to rebalance like 3 times a week, and it's crazy. So I said, you know what? Let's change things. Let's see if we could speed things up by no longer checking market capitalization. Now, our market data services provider, it's a professional provider that we pay to give us data, they have like 20, 30 stocks that have like broken market cap. And I gave them a list and they fixed it. And then we were down to like 6 or 8 market cap broken stocks. And it's fine. So at 1,000, 10,000 tickers trade every day. The question is, where are we? And so we eliminated the market cap limit. That means all stocks, big and small, including our personal holding, Corbis Pharmaceuticals, which, by the way, in our model is one of the 50 worst stocks to invest in. And we own it. God, I feel so great about that. It's not a lot of money, but wow. So here's what we did. When you take out the market cap limit, we now are analyzing 3,450 U.S. common stocks. And we're doing it in a relatively time-efficient manner. And so, first off, that's great because we doubled the alpha of our run by allowing small caps back into the mix. So, first thing to tell you is a mix of large cap and small cap will help you get more alpha in the market. Okay, not a mystery, but nice that you can prove it. The second is, regardless of the market and the details of how we run our analysis, the best portfolios are getting smaller. And we call that risk off. Now, I made a nice, pretty picture for everybody. Let's see if I can find it. My risk-off picture. Risk-on picture. So when I say risk on, I mean get in the starting blocks, because it's a better time now to take a little more incremental risk by having fewer larger portfolio sizes. That's how our model says the benefit of diversification is slightly lower. The benefit of stock picking is slightly higher. So, and that manifests itself into stocks like Zim, which is a shipping company, Workday, T. Rowe Price, Rocket Mortgage, Marvel. I think LAZ is Lazy Boy Chairs, which is, my God. Avgo, which is Broadcom, Amazon, American Financial Group. Some of these are high dividend payers, and that's how they made the list. Others are maybe just a little bit different. So a 14 stock portfolio has State Street and Microsoft and Etsy. And then you get to an 18 stock portfolio, which is completely different as well. So we're finding some interesting, some are financial services focused, some are more different, like Main Street more focused. It's just interesting. So 13 and 14 stocks, we were at like 30 to 40 stocks a week ago. So I can't really tell you exactly how that happens, but I can say this. So we are risk on, and risk on means some things are happening. The first is the variance of the S&P 500 is dropping. The amount of volatility, price variance over time is shrinking. Now, it's hard to shrink a year's worth of variance in a material way, but it's happening. So the first thing to look at is a year ago, it must have been really crazy. And so we're working off last year's craziness. But it also means current price action is calm and more subdued. And I will say this, I notice it. I have a lot of tabs open. This morning was crazy stock market review time. And I'm going to put another one up here. And so one of them is FinViz, and I love it. I use FinViz. I like FinViz. It's simple. And when you look at the market leaping higher, gapping higher, it's only up 0.75%. Yesterday, the market was down. Oh, it was crashing. It was down 0.25%. I think it finished up 0.5%. So the numbers are smaller. We're right around 4,000 and the variances are smaller. And so smaller variance means you can take more risk. There's less risk in the position. Now what's interesting is, for those who follow our show and follow our methods, the overarching parameters of our model have not changed this week, and yet we've moved risk on. This is very important for you to think about. The risk-free return is still 4.8%, which is slightly higher than your 1 month and 13-week treasury bills. And our market index floor is 8.57%, which is a 7% capital return, capital appreciation, and 1.57% dividend return, which puts you at around 4,300 at the end of like in a year. 4,300 is not blowing the barn doors off. 4,250, 4,300. So we haven't changed that. The return to risk is only 4%. So you can see very few stocks are broken anymore, right? And this one, CEQPP, it's a preferred. Crestwood Equity Partners, I'm good with that one. So there's very few stocks that are broken. So checking market cap is fine. 3,435 stocks is a lot of stocks. 9 and an eighth return on the overall portfolio of 3,435 stocks. You can see 4 stocks actually score better than what would be the S&P 500 or what would be this whole portfolio, which is Tower Semiconductor, MoneyGram, Berkshire Hathaway, B Shares, and P&M Resources. What's interesting then is, so we've sped up the model dramatically. there's a lot here. Just if you buy a run, you get all the data, you love it, you learn all about stocks. It's terrific. So our fast quanta genetic algorithm run did not give us a very good answer. And so we are constantly experimenting to make that. I'm actually looking on our server. Yeah, we can get a great answer, but to be honest, it takes a long time. It's taking 44 minutes. I don't want to take 44 minutes for a genetic algorithm to find a best answer. You know, it found the 13 stock great answer as well. 4,340 seconds. So I'm trying to tune it. Genetic algorithm is not the fastest way. Custom coding your own simulated annealer, which is like a D-wave quantum annealer, but we use Dell for it. That's fast. That's 14 minutes. It's 14 minutes. We run it twice. We get different answers because it is random. We run an unseeded Monte Carlo. We do okay, 40% of the answer. We run a seeded Monte Carlo. We get half the answer, half the quality. We run a genetic algorithm exhaustive, and we were able to get a pretty good answer. Not the best answer, pretty good though. And then you can run a reverse simulated annealer and make sure you're doing okay. In this case, it did not improve the answer. And so leptokurtic stocks, more of them. There's 35 leptokurtic stocks. So these are stocks where if you think you are safe, think again. And I made 2 videos about it because these stocks have been getting picked off like from snipers. Now I noticed some names here. And I want you to think about this for a minute. A leptokurtic stock is a stock that has more data in the tails. So if you're thinking about a bell-shaped curve and what your next, what tomorrow's stock market return is going to be, there's a much greater chance than as a normal distribution of having a surprise. It could be a good surprise. Hey, Christmas came early, stock went up a lot. But it also could be a bad surprise and the stock could fall. And if you're a risk-worry investor, you worry about that. So MO, Altria, made our list. Kellogg, Hershey's, Hormel remains on the list with an unbelievably high leptokurtic score. Activision, CVS, Electronic Arts, General Foods. But the thing that really hit me was AT&T. AT&T is more likely to have a dramatic move. STZ, which is a food company. So your food and beverage companies, which should be safe, are showing some gaps. Now remember, we more than doubled the number of stocks that we put in our model, and what that really did was it raised the variance of the pool, which allows for more stocks to make it as low variance because they're low variance compared to the pool. So I get that. We could look at that. But it's interesting to see some of these high leptokurtic values, PFS, SJM, which I think is Schmucker's Jam. A 13.8 leptokurtic score is the highest one, except for PFS. So Smucker's is in for some spreading. Okay, that was a bad pun. Guild as well. So platykurtic is safe. There's less data in the tails. There's less likely to be a big multi-standard deviation move tomorrow. Now, those you might look at and say, okay, Otis Elevator. Okay. Pfizer. Less likely to surprise. Yum Brands. Okay. I don't know. But it's interesting. So if you hold these stocks, maybe you sleep a little better at night. I would. And then we look at the best portfolio. And there's a couple here. I mean, my point isn't to focus on the stocks. It's to focus on the fact that our market is reading risk on. And the fact that we now have 3,450 stocks showing up in our model is just insanity. We're going to scroll to the very bottom to look at the worst stock. So if you wanted a down run, Jeffrey, tell me the worst 10 stocks. Highest risk, lowest expected return. Atlas Lithium Corporation. By the way, that's an error in the... It's got to be an error in the market cap. Comm Sovereign Holdings. Comms. Contrafect. Jaguar Health. Revelation Biosciences. We're just waiting for God to tell us. Baudax. Corbis. And then there's some other therapeutics in there. eHome Household Services, which I believe is a Chinese company. Oh my God, I think I was talking about shorting that stock about a year ago. Well, it's still, it's worth $8 million. So the question is, some crappy little Chinese company, but it's only worth $8 million. You could pump a stock if you're rich enough to that level, right? Bork's Technology. I don't know half these companies. SNDL. Oh, I remember that one. That was a memer back in the day, right? And so these are your crappy stocks. So we talked about like Berkshire Hathaway was a low risk stock, right? Or MoneyGram. And now you've got Atlas Lithium, Comm Sovereign, all the way up through Corbis as being your worst risks. And that's okay. Then you still got your high dividend stocks. These are stocks that are probably spun off companies or made one-time payments, right? Bulk Carrier, Ocean Group, Shipping. So shipping companies made a lot of money. So, oh, we have a little echo. Thank you for telling me. Appreciate that. Sorry about the echo. Let's see if I can fix that. I might be able to. It's probably the server that you hear. Thank you. So those are the stocks that have a 5% or more dividend. There's a lot of them, right? So there's a lot of stocks that are paying you to hold it and have made one-time payments. Now, what was interesting was there's many more negative beta stocks. So a negative beta stock moves opposite to the S&P 500 and has done so over the past year. And what's interesting is there's more of them. So when the market went risk off, the market moved together and those negative beta stocks disappeared. Thank you. What happens now is there's more stocks that are showing up that are moving independently of the S&P 500. That's interesting. That gives people an anomalous way to trade. And so I'm going to update the website with some of this info. So in conclusion, what happened? We sped up our run. We sped it up a lot. By speeding it up, we allowed ourselves to increase the number of stocks we look at from 1,600 to 3,400. Number one. Number two, market risk is lowering. We're seeing reduced risk, and as a result, the return to taking some risk has gone up. The market is now a little more risk on. It's a 9% expected return to holding stocks, but the variance seems to be lower and more stocks are standing out as being low risk. That's good. It also means that the model is picking stocks. The model is picking portfolios that have fewer stocks in them. And as a result, you can have a 1.3 times 10 to the negative 4 edge, whereas last week it was 5 times 10 to the negative 5th. So it was half or less than half the edge. So you're getting more edge. And you don't have to hold a lot of small, crazy stocks. You can hold Etsy. and Broadcom and Amazon and Marvel and Microsoft and Rocket and State Street, right? It's interesting. The stocks that are being picked are more interesting. We've increased our dividend bias mitigation to 75%. Now, I bring that up because one of the stocks on this list, Zim, may not deserve to be on the list. Zim paid an enormous dividend last year, probably will not repeat the dividend. And so it's getting help, right, in our run because of the high dividend. It's a dividend bias. And so we're only accounting for 3/4 of the benefit of dividends in our run. If we were to run at 100%, then companies like Zim would just show up so much higher and crowd out other stocks. So we've been having to work the dividend mitigation parameter in our run. So thanks a lot for watching. It's a risk-on day, and it was interesting because I posted it was a risk-on day before I looked at the stock market. And you can see the spider, which is trading, it was getting close to 390, is now right around 400. So stock indices are up. In fact, we can look at Cohen and you can see that. I have so many things I can show you today now that the main part of the video is over. But the big thing is, let's see if the market is reflecting a risk-on day. Going to Cohen, NASDAQ, S&P, and Russell, 5 days. And so you can see for 5 days, the market really worked its way lower, but again, not much. The whole flow in 5 days is up 1.5%, down 1%. So to see a 2.5% spread over 5 days is a big deal, because you can see that earlier the market had dropped. You were looking at a drop of like 5% over a month. That's a pretty big drop. And so to see things they're moving still, but they're kind of settling in is good news if you're a risk-focused investor. So you can see when you look at the market sectors, normally the percentages were 2 and 3% when the market got crazy. Now you're looking at the worst sector is down 0.8%. The best sector is up 1%. Smaller moves. Smaller moves, less crazy, means you could take a little more risk. Okay. Well, that's terrific. I get it now, right? That's where we're at. And so I may make another video a little bit later on today and show performance by industry sector and things like that. But just know that for today, we're risk on, higher return to stock picking, fewer stocks can be in your portfolio. There is lower risk underneath the movements of stocks. Thank you very much for watching. If you like the video, we're not paid to make them. Hit the subscribe button and drop a comment. That would be great. We're happy to respond. Thanks.